Hello and welcome to the Golden Thumb Rule, a podcast where we decode investing wisdom through simple, timeless rules. Now, today's big question that is on every investor's mind is what should be the golden thumb rule of investors for managing money across cycles? Now, joining us today is Hitesh Zaveri, who's a senior vice president and head listed equity alternatives at Axis AMC. Hitesh, great to have you with us on the show.
Good to be here. Good morning.
Thank you so much for taking the time out, Hitesh. And, after spending more than 2 decades in investing through multiple cycles, what is the single golden thumb rule you follow to protect capital first and compound later?
That's a good question to start with, Kshitij. We are essentially, value at a reasonable price and value-oriented investors. I've been doing that for a while now, as you pointed out, for more than 2 decades, and it has really worked for us. Um, we noticed that, of course, that in last maybe couple of years, except last 6 to 9 months, it
Hmm.
is growth that has worked well. But over medium to long term, the global evidence is overwhelming that how value orientation, value at a reasonable price works. Uh, Growth cycles, one needs to ride them. And, as a country such as India, when we are doing fantastic nominal growth of 10, 11, 12% a year, there are opportunities and pockets where one should ride growth, and we do. But fundamentally, we are, growth at a reasonable price people.
So market changes, narrative change, but what is the one rule of money management that has remained, let's say, constant across cycles for you?
I think safety first. The fundamental rule of investing is, your capital protection and safety first.
Okay.
I mean, the biggest risk any investor, the risk that is not to be taken is any potential of capital depletion. And therefore, what follows is what are the quality of the company that you're buying, at what price are you buying them, what are the growth prospects of the company, the return equity that the company makes, the dividend payout policies, and of course the regular list of risk factors that one would study.
Yeah.
But the fundamental, of course, it will start with capital protection. If you're protecting your capital and compounding, then you will have staying power. Without that, everything else will be difficult.
There's another question which usually a lot of investor struggles with is how many stocks should be there in one's portfolio? Some would say that 10 would be enough, or some would say, five would be enough. If you have all the good companies, five stocks would be enough, but then, so that you can diversify, then go on to 10. So my question to you would be, what is the practical thumb rule to decide how many stocks to hold, how big each position should be, and how much risk is acceptable, so you can sort of generate alpha without risking survival?
I first of all, I think that the considered portfolio is highly risky.
Mhm.
Over the medium to long term, the risk is fairly high, and one should not prefer to do that. And the reason is, let's say, for example, you have 10 stack portfolio, and then let's say your position number two or three is, 12, 13%, 14, 15% of the fund. And then something happens, something adverse happens to that position. I mean, it will be difficult to beat benchmark if two or three positions don't work out well. If you were to go back to the theory, they around 16, 70 is the minimum number of stocks that you need to have
Mm,
to be able to properly be diversified.
mm.
Um, our view is that we should have 25 to 30 stock portfolio, even for individuals.
Okay.
Uh, at least at the minimum, have 25 names across 5 to 6 industries. um, Try and have non-correlated positions. If you like consumer space, of course, that looks great. Make
Mm,
sure you have enough financial positions, you have enough industrials in your portfolio, automotive. Just to give an example, not necessarily a sector recommendation, but idea is to get the safety in the portfolio. The proper diversification is necessary. From time to time, it will look lucrative when concept portfolio or some position becomes very high and you want to put a lot of your eggs in one basket.
that's right.
But then it's not that easy to keep on watching that basket despite that adage to that subject.
What is the thumb rule for the risk management that helps investors survive deep drawdowns without exiting the market?
That's an easy question, Kshitij, because as we shared earlier, I mean, if step one, capital protection, step one.
Right.
Uh, just ensure that the quality company of the company that we're investing in, at what valuations we are getting in it. It's one part of the story that it's a great company and it looks very interesting. Growth prospects are good, but it won't help that much if the valuation entry points are not in your favor.
That's right. Yes.
Um, so I think there'll be a great starting point. The second also, like we covered, as to be diversified. Make sure you have enough in more stocks. So your fortunes, your future prospects in the investment industry are not determined by two or three stocks, and that may, in case they go wrong, you're still there in the market to play the next cycle.
Mm.
So that will be the second one. Third is be research oriented. I It would be important for investors to be a reader,
Mm.
to know stuff. We are luckily living in an era where information is more accessible than ever before. We have never had this situation,
Mm.
if you go back to any period of time in the past,
Mm.
where it was easy to get the annual reports, the conference call transcripts, the sell side research reports, the quality of the websites and what companies put on them. The information has become very easy to get. So the research at the investor end has become much easier to do.
Okay.
And I think that's an important exercise for any investor to be doing.
Absolutely. Does position sizing also comes into play? And if you can just quickly help us with a couple of points on the position sizing, what should ideally be?
So I think small and mid cap do have some space. Should of course should have some space in the individual portfolio, but we tend to be biased in what is there in, for example, in BSE 100,
Exactly.
Nifty 50, and so of course there are pros and cons. The pros are in the large companies that you are safe. Companies are very well researched. Managements are proven. Managements have track records of 2, 3, 4, 5 decades. Um, the organization structure, the leadership, all of that are of very high quality. Brands are well known, so on and so forth. There are enough and more positives. And over the long term, the returns are decent. In India, over the long term, we have compounded at 14% or so, which is a great return in rupee terms. Uh, in small and mid cap, there should also be space, because in a country like India, when we are growing at 11, 12% nominally a year, there are enough and more sectors opening up where small and mid caps are
Mm.
more agile, more entrepreneur driven, more leadership driven, uh, and investors can make really strong returns. Though I would think that to go beyond 25, 30% or even more than a third,
Mm.
it's not necessarily prudent unless you are a professional investor. You have lots of time on your hand and you want to do a lot of research yourself. Uh, Without that, I think up to a third in small and mid cap would be a good benchmark to follow.
All right. And in euphoric bull markets, what is the golden thumb rule to avoid giving back years of compounding?
That's a great question, Kshitij. It takes me to, it reminds me of a book title that I really liked. And the title of the book was, It's Only When You Sell That It Counts.
Yes.
Right? So people have had a lot of paper profits over the years, only to see it dwindle because position, that you didn't sell it the right price. The whole point of buying it at attractive price, the whole point of doing the research, understanding companies' brands, growth, distribution, and what have you, is to see the stock price, rise. And when the appreciation happens, then you, at a fair value, somewhat higher than fair value, you exit. That's the whole point of investing, right? Um, and many times investors miss out on that. Um, and to answer your question, I would really look out for what are the reasons for me to buy a stock in the first place,
Okay.
and what is my target price when I'm buying into them.
Mm.
And when the target price is reached, do a more serious evaluation. Do we really need to keep it, or we should be recycling the money? I'm not suggesting that one should trade and trade frequently. Having said that, I think it makes sense that when your target price is reached, that you recycle the money and then look for the next opportunity.
Right. No, absolutely. It does make sense for investors to have a more logical approach to their trading or the investment journey. Now, let me also come to my another question, and it's a very interesting one. What is your golden thumb rule for building portfolios that can survive both bull and the bear phases?
Again, a great question. I mean, so we are very much interested in, the valuation of the portfolio at gross level, the weighted average valuation of the portfolio itself. All the individual positions are critical. Um, so the golden rule is, how can the whole portfolio contribute to the appreciation that we want? How the
Okay.
whole portfolio can contribute to the beating of the benchmark.
Mm.
Inside of that, the prospects of each company, are thoroughly studied. I mean, right now we all care about how FY27, FY28 is going to work out. Just to make this point very topical, we are seeing that, many commodities like copper and aluminum have really risen. Crude, on the other hand, is benign. And therefore, we are very interested in, who are going to be the net beneficiaries and, people who are going to be hurt by it. Which companies will have lower earning because of this development, just to point out one or two. And then, adjust our forecast accordingly. And so therefore, the golden rule there is, make sure that the whole portfolio is a performing team. You don't want your
Mm.
IPL team where a couple of people won't perform or fewer won't perform. The whole team needs to pull its weight. In the bear market, the difficulty of operating in the bear market is, the stock decline tend to be kind of universal. Too many stocks are falling at the same time,
Mm.
and that makes it very complicated.
Yes.
Um, Therefore, I mean, the main protection one would have here is which is the quality, what are the quality of the company that you're invested in.
Right.
Lesser quality will risk higher fall, right? Higher depreciation the prices when the full blown bear market is in operation. If two-thirds of your portfolios are in quality large cap,
Sure.
you are protected the whole time. Investing
Absolutely.
is a long-term game, Kshitij. So investors who think of 5 years, 10 years, 15 years,
Mm.
they will do really well sticking to the basics.
Absolutely. No, well said there. And let me come to my last question, and that is probably one of the important ones, and which has a more psychological impact. So, what is the biggest behavioral mistake investors make in different cycles, and what would be the thumb rule which will help avoid it?
A great question again, Kshitij. I think it's difficult for investors to act by keeping emotions aside.
Hmm.
I mean, the most fundamental emotion that one would hear the whole time is greed and fear, isn't it? In equity
That's true.
investing, and when the stocks are going up, stocks from one sector, one industries are going up. So then, sometimes the greed takes over. Then some fundamental changes, and then the whole cycle reverses and reverses very quickly. Similarly, on the fear side, we just talked about, what happens in the bear market. It's a biggest mistake not to be buying aggressively in a bear market.
Right.
Now, when it may happen if the bear market lasts longer than you would want it to,
Mhm.
or bear market, gives you some short-term losses for a while. Idea is to have your holding capacity. Idea is to
Mm.
know that you are in a good quality company, the valuation is good, and market will take care of itself over the next 2 to 3 years. We are a very large investing cohort in India. We have, crores of quality individual investor operating. We have, 35, 40 high quality mutual funds that are operating, hundreds of PMSs, AIF funds, of course, the foreign funds. It will be very difficult to keep a quality company suppressed.
Yeah.
Anywhere you see quality, investors, institutional investors are going to come and take it because
Mm.
that's the objective, right? So, so the golden rule, therefore, in a bear market, if you see some situational opportunity, is absolutely to go ahead and take it.
Absolutely. Well, on that powerful note, thank you so much for taking the time out, Hitesh. It was lovely talking to you, and thank you for all the guidance and the knowledge that you've shared with our viewers. Thank you so much for your time.
Great to be with you. Thank you.